Now, with all of these breaking headlines swirling across the pond, we have government problems of our own. That is the shutdown. All of this, could it have consequences for banks in the UK? And what about here? JPMorgan Chase Chairman and CEO Jamie Dimon warned today about grim consequences of an extended government shutdown. And here's the quote. Someone estimated that if it goes on for the whole quarter, it could reduce growth to zero. Dimon also told reporters this morning, we just have to deal with that, and it is more of a political issue than anything else. It is what it is. Now, he did add that a functional Washington, meaning one that actually works, could reinforce, quote, already strong consumer and business sentiment. But JPMorgan's fourth quarter earnings missed profit expectations for the first time in 15 quarters. A quarter, we should note, that was barely touched by the shutdown. Was Jamie Dimon blaming the shutdown for the miss? Let's bring in Rafferty Holdings' Dick Bove. He's the man who translates bank speak better than anybody. Dick, we got a lot to really discuss and attack here, but help us see this clearly. I want to make sure we get this right. Was Jamie Dimon forecasting trouble ahead or spinning last quarter's problems at his banks? And I ask that because the government shutdown started December 22nd, just a few days before the end of the quarter.
No, I think he was forecasting trouble ahead. I think some of the statements he made were more negative than I've ever heard any bank CEO state ever. For example, walking away from the quote that you just gave, he said that he had told his lending officers if they had reduced size of their loan book, that would be okay. He said he didn't care what would happen in the first quarter because over the longer term, they would do okay. He also, and Marianne Lake, the CFO, seemed to reinforce the view that they didn't want to be aggressive underwriters at the present time. They were willing to give up business to non-banks because they don't like what is going on in the overall, whether it's the economy or in the loan industry itself. And you know, bank CEOs don't say those things. And when they do say those things, you got to take heed because they're not very positive.
Well, Dick, let me broaden the aperture and ask, in essence, do you think the shutdown, how do you expect that it might, in this current quarter, when we eventually do get the earnings, how might it affect other banks? And would a size of a bank be incrementally affected, sort of if it were a smaller bank, or a larger one is going to be hit more dramatically?
Well, I think it's the type of loan that the bank makes that's most important. In other words, most commercial banks in the United States are just that. They make commercial loans. And to the degree that we're seeing companies pull back, and what we have to look at is what is happening to middle market lending in the United States. What are these banks telling us about that? And if they're telling us that basically middle market lending is weakening, what they're telling us is that the confidence of the business leaders has weakened somewhat, and they don't want to take aggressive moves to expand their businesses. And of course, if that happens, then there will be significant problems with the economy.
Yeah, I'm wondering, because you talk about what's happening with the economy. To me, the data look pretty strong. We got that very solid December jobs report. But, you know, if you started to count how many voices at the Federal Reserve have joined the chorus, they would put the Mormon Tabernacle to shame. This is a huge number of voices who came out within the last 24 hours. First here on Fox Business with Edward Lawrence's interview with Richard Clarida, who's the vice chair, who was saying that he felt that it was great to be patient, that the data look fine, but we can afford to be patient. And then, I want to say, was it around what time? Probably around 11:40 a.m. Eastern, Neil Kashkari, I think we have a graphic here for this. Neil Kashkari of the Minneapolis Fed said, no need to tap the brakes, meaning the rate hikes, as long as inflation is low, doesn't see the data to sort of support future hikes. Then Esther George of Kansas City turned dovish. She had been more of a obviously an eagle or a hawk. She said might be a good time to pause and be patient. And finally, Robert Kaplan warned around 1:40 p.m. Eastern that the stimulus bump, I found this interesting, I'd like your opinion, stimulus bump from the tax cuts is starting to wane.
Well, my perception has been what it was, a few months ago, that if the President of the United States goes after the Fed will cave. And the reason for that is, if you go back in history, no one who created the Federal Reserve back in the 1906 to 1913 period ever imagined that the Fed would be independent. There was no desire whatsoever for it to be independent. In fact, there was a huge fight to make sure that it would not be independent. And other than the last couple of presidents who have kind of turned a blind eye to the Fed, every president in the United States has gone after the Fed. And when people go after the Fed doesn't fight. The Fed steps back. And that's exactly what they did. Now they're finding all sorts of economic reasons. We want to be data dependent, and that means we don't know what the hell is going on. So I think that's why these people have all swung their positions. But the fact is, they're right. The Fed was too tight. The Fed should have eased. The Fed will ease, and that will be positive for the economy.
We've got to deal with our own economy and get a commercial break in here. Thank you so much for joining us, Dick Bove of Rafferty.